Shares of Nvidia are down 23% from their high, and I don't think the drop in the stock is going to stop anytime soon because there are some negative trends for the company's operations. But there are a couple of stocks in the AI space and the technology space that I think are in much better position, could actually be taking some of the margin that Nvidia is generating today, take it for themselves in 2025 and 2026. I'm going to get to what those two stocks are in just a second. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start with the drawdown that we've seen with Nvidia. You can see here, shares are down 22.9% as I'm recording near the end of the trading day on Monday from their all-time high. So what in the world is going on with Nvidia? There are a few trends that we need to look at. The first is the company's revenue growth rate. You can see that this is the quarterly numbers. The revenue growth rate ticked up in the middle of 2023. Remember that ChatGPT moment was late in 2022. That's when orders started to come in. Their new chips started to sell like crazy in 2023. That growth picked up in 2024, over 250% year over year revenue growth, but that growth rate has slowed down. Now, one of the things that investors don't really like is when the growth rate slows, not that growth is slowing. Nvidia is still a growth company, but the rate of growth in the most recent quarter, 78% from 262% just a few quarters ago. The other same thing we're starting to see is a little bit of pressure on their margins. You can see that margins peaked at 78.4% for gross margins in April 2024, and that's the quarterly number. That was also the peak for operating margins at 64.9%. So those margins are starting to slowly come down. And where are those margins going to end up? Well, historically, Nvidia's margins are nowhere near what we see today, especially on the operating side. Now, the company is going to have operating leverage given the scale that it now has in the AI business and the operating costs that it takes to get there. So I do think their operating margins are going to be higher than they were typically in that 15 to 30% range. But is a 62% margin going to be something that they're going to be able to maintain long term? I really think that we need to question that. So if you have the growth rate slowing, you have the margins starting to come down, then you need to start thinking about what are we paying for this stock? And that's where you can look at Nvidia's price to sales multiple and price to earnings multiple and start to get a feel for just how expensive the stock is, especially compared to their historical averages. What you see in this chart is the price to sales multiple in green. In 2016, the price to sales multiple was about 2.5. Right now, the price to sales multiple is about 24. So that multiple has expanded dramatically. The price to sales multiple, compound annual growth rate, almost 25%. That alone would have beat the market over the past decade. Price to earnings multiple doesn't look all that crazy at about 40 times earnings. But again, if the growth rate is slowing and your margins are going to come down, is it possible that earnings are actually going to come down in the future? And should you be paying a 40 price to earnings multiple for a company that isn't necessarily going to be expanding margins in the future? I think that's what investors are starting to question. So who's actually taking those margins? That's where we get to the opportunities that we do have in other stocks in the AI space. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The first company that I think has a huge opportunity is Taiwan Semiconductor. Taiwan Semiconductor is the company that makes Nvidia's chips. They are also raising their prices in 2025 because they know that they're the only company that can make these high-end chips. Now, they don't make every component that goes into like Nvidia's Blackwell chips, but they do make some of the most critical components. And so they're going to be able to raise their prices basically as much as they want and take more of that margin because they look at Nvidia and go, hey, wait, you're making a 62% margin. We need to make a little bit more margin for ourselves. That is being implemented this year in particular. So we're going to see the margin decline for Nvidia is partially going to be going to Taiwan Semiconductor. The other thing you get with Taiwan Semiconductor is a little bit better value. This isn't the cheapest stock, and it is a company that's very capital intensive, so I want to be sure not to necessarily overpay for it. But the price earnings multiple is currently about 23, and the forward PE multiple is about 17. So if they are able to continue to grow as more of these advanced chips are demanded all around the world, they're able to take a little bit more margin. I think that's going to put them in a really good position. Isn't going to be as flashy a company as Nvidia is, but it is going to be a company that is going to be critical, and it's going to play a huge role in the diversification of AI chips. If Nvidia is going to lose market share to any of these other companies, whether it's customers like Microsoft and Meta and and Amazon, or to direct competitors like AMD or Broadcom or even Google, it's going to be TSMC who's going to be making those chips. So I think the company is really well positioned for the growth of AI overall. And speaking of companies that are very well positioned, the second stock that I think is a better buy today than Nvidia is Alphabet. Alphabet is one of the dominant companies in technology today, and they are also a leader in artificial intelligence, not only making their own models, but they have the best distribution. Billions of people use their products, and they're just starting to fold artificial intelligence into those products. They also have the best infrastructure. So you not only have the cloud business, but everything that goes into that, all of those milliseconds that they've taken out of each search that we've been doing for the last 20 or 30 years, that is now manifesting in having better infrastructure than its other cloud competitors for artificial intelligence. The cloud business alone, this is the best proxy that we have for their AI business. That's growing at about 30% per year, and I think that's going to compound for the foreseeable future. And the company overall is a pretty good value. As I'm recording, the forward price to earnings multiple is only 19. The trailing price to earnings multiple is 21. So this is a company that overall very diversified, growing in many different areas from YouTube to Google Cloud to search. They also have companies like Waymo, which I think are really underappreciated what their potential are. And they're generating, and Alphabet is generating a ton of cash. Don't forget that this is a cash machine. So even though that capital spending that they're going to put into artificial intelligence, all the money that they're putting into their custom-made TPUs and quantum computing and all of that stuff, they're still generating a lot of cash from the core business. So I think Alphabet is a phenomenally positioned company because they own the best distribution points for artificial intelligence today. Nvidia has a very powerful position when it comes to the developer ecosystem and building those models. But what are we going to be using AI for in the future? Probably going to be on our smartphone. Who powers most of the smartphones in the world today? Android does. That is owned by Alphabet. I think that's going to be a phenomenal position, whether we're doing that compute on device, on a TPU, on one of their devices, or whether we're doing it in the cloud, in the Google Cloud. So as Nvidia stock falls, as their economics get a little bit worse, remember, still a growing company, still a phenomenal company, still a very profitable company, but not necessarily a great value as that growth slows and margins start to come down in 2025. I think better buys today, Taiwan Semiconductor, and Alphabet. But let me know what you think in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.